Welcome back, chart addicts. In this video, we're going to discuss the Fibonacci retracement tool. We got tons of messages across social media like this one and this one of people claiming that the Fibonacci retracement tool doesn't work. We're going to explain what the tool is and how understanding how it works can allow you to get better entries. Let's go ahead and check this out. All right, so let's talk about the Fibonacci retracement tool. So the Fibonacci retracement tool is a qualitative analysis tool that allows traders or analysts to measure market corrections. So markets don't move in a straight line. They typically move in waves. They move in waves of impulse moves and corrections. And so all the Fibonacci retracement tool does is allow you to measure the most recent correction so you can find an entry for the next big push. And so if markets don't move in a straight line, they move in patterns of pushes and then pullbacks, pushes, and pullbacks. The Fibonacci retracement tool allows you to measure the pullback so you can have the most accurate entry when looking to trade a trend. So there are two main types of corrections in the market. The first one is a shallow correction or a shallow retracement. And the second one is a deep pullback, deep correction, or a deep retracement. Those words are interchangeable. So the first one can be characterized by a pullback of anywhere between 20 to 40% of the impulse. And so the impulse goes up and then it retraces back 20 or 30% of the overall move before it continues to the upside. This typically happens in more aggressive trends. And so the stronger the momentum in a specific direction, the more likely you are to see a shallow pullback. Deep retracements typically happen between the 50 and 80% pullback of the recent impulse. And so you'll have an impulsive move push up, come back down anywhere between halfway to 80% of the way before it continues and creates new highs. The basic composition of a Fibonacci retracement are the retracements and the extensions. We use the retracements and all of these retracement levels to find execution entries, and we use the extension levels to find our targets. When using the Fibonacci retracement tool, you'll be using the retracement levels as your entries, and you'll be using the extension levels as your targets. So the way this works is when you measure a recent impulse and you find the entries at these Fibonacci levels, you'll be placing your entry at the Fibonacci, your take profit at the extension, and your stop loss below a previous area of structure or below another Fibonacci level. So it's a very straightforward way of how to use the Fibonacci retracement tool to find entries and exits in the market. The last thing to understand about Fibonacci retracements before we go on to the live charts is what these numbers actually mean. A lot of folks get intimidated by the Fibonacci retracement because they tend to think it's mathematical. Really, the Fibonacci retracement is a qualitative tool, which means it's more observational than it is quantifiable. And so when you look at these retracement numbers, all they do is correspond with a percentage. This 0.5 corresponds with 50%. This is how decimals and fractions work in case some of you guys didn't pass middle school. 60%, 70%. Okay, so 0.6 and 0.7 and 0.78, these basically equal 60%, 70%, and then 78%. So how you can read this is, if the market pulls back to the 0.7 Fibonacci level, what that indicates is that the market has corrected 70% of the recent impulsive move. If the market has pulled back to the 0.5 Fibonacci level, it means the market has pulled back 50% of the first impulsive move. Understanding what these percentages mean can allow you to explain what's happening on the charts and allow you to get a better perspective so you're more prepared. Let's see how this looks in the live trade. It's important to remember that the Fibonacci tool is not the only qualitative tool that you're going to use to find trades. It's going to be probably the fourth or fifth confirmation on your list. Price action needs to be the first confirmation that you use and should be the main reason why you enter a trade. The Fibonacci retracement is going to help you get much more accurate entries and allow you to maximize your risk and reward potential. Let's demonstrate the Fibonacci retracement tool on Euro USD and show you how understanding these basic concepts could have allowed you to find these higher time frame moves and allow you to take advantage of these in a very simple way. In front of us here, we have the daily chart of Euro USD. So no surprise, we've been bearish since the very beginning of the year, which means we've been on a consistent downtrend. What I want to show you is how understanding the Fibonacci retracement can allow you to find perfect entries on the higher timeframes using a very, very simple trend following strategy. So if we find the highs and lows of Euro USD and we map them out, we're going to use the Fibonacci retracement. I'm going to show you how finding the 50% correction zone could have allowed you to take trades consistently along this trend throughout the year. So here's the top of the trend. We'll go ahead and start measuring our Fibonacci from the most recent impulsive swing high down to the recent swing low. By measuring this impulsive move, all we have to do is wait for the correction to one of our key levels in order for us to take a trade. It's important to remember before we continue this exercise that different pairs respect different Fibonacci levels. It's important for you to backtest a specific pair and a specific trading instrument so that you're more comfortable and you're more aware of which levels that it typically respects. Let's keep going with the exercise. What we can see here is that by measuring the impulsive move from the swing high to the swing low. We had a 50% correction here that could have been a perfect entry for us to execute and trade along with this trend. We also see that if we were to use the Fibonacci extension levels, this -27 and the -61 level as a target, we would have had a perfect exit of this trade. So again, you measure the recent impulse, you find the pullback, and then your take profit is going to be this extension level. But surely that's a coincidence, right? Sometimes the market's not going to respect 50%. So let's keep going and measuring these impulsive moves and seeing if there's a pattern here or whether or not this was a coincidence. So the next swing high to the next swing low, we're going to measure this all the way through. And what do we find? Again, we had a beautiful correction to the 50%. So the market dropped, came back about halfway, and then continued. If we draw out our zones, we can use the extension level, -27 as our first target, and the -61 as our next target. But you know what, Roy? I'm still not convinced. 2 times, not enough for me. Maybe it's just a coincidence. So why not keep going? So I'm going to measure this impulse all the way down and see if we can get some kind of correction. And again, we had a nice drop from the recent swing high to the swing low, a correction back 50% of the overall impulse. And then again, we can use the -27 and the -61 as our targets. So the first time that you do this exercise, it may seem a bit coincidental and it might seem a bit random, but after you practice this exercise over and over again, hopefully you'll start to realize that there's a very specific pattern in the way that markets move and that using the Fibonacci retracement tool can allow you to get the best entries and to get the best risk and reward. Best of luck, chart addicts. Take it easy.